Friday, March 27th, 2020, Monaco 64, home of alternative economics and contrarian views. I don't want to sound alarmist, but I noticed this morning the Fed's balance sheet is just going over 5.25 trillion, a massive increase of around 40% since the low last year, around 3.7 trillion. And this is only about a week after they announced open-ended QE. Can you imagine where that balance sheet will be in a few months' time? It's really how can I say? Yeah, it's concerning. And what does that mean for you and for me and for the general public? Well, it means that the value of the dollar bills that you hold in your wallet or through an entry in your bank account, that's gonna evaporate the value, the purchasing power. It might not happen in the next few months, but it will definitely happen in the next 18 months to 2 years, and maybe even before. Yeah, this is classic hyperinflation, classic monetization of the debt by the Federal Reserve. Yes, they say that they don't buy the debt directly from the U.S. Treasury. They do it through the primary dealers, the Wall Street firms. But it's as good as. And plus, with the 2 trillion package from Congress, that could increase. Apparently, that's one of the reasons why the markets went up yesterday, because jobless claims spiked to an unheard of level of almost 3.23 trillion for the week. So now people expect even more largesse from Congress. The Fed, of course, they've got an open-ended keyboard or reserves. Quite amazing. One of my viewers, he's got his own YouTube channel, Justice Americas. He sent me a little video he did, and I'll put it up in the cards, where Jay Powell is speaking to a reporter on TV, and he says that the Fed has unlimited reserves. There's no problem for the Fed. They can create as much of this funny money as they want. I think it's you really need to run for the hills if you have too many Federal Reserve notes as savings. And what do I mean by that? Well, you need to try to get anything that's tangible, anything that you can hold on to. Precious metals, of course, gold and silver. These in the US could do well. I know I'm in the UK, but they probably will do well here as well. These are the silver quarters. These are really nice to have. Half dollars as well. Yeah. What about the stocks, equity market? Is it okay to hold some of that? It could actually be in the longer term in the hyperinflation, but it's very tricky. I've done videos in the past and showed how actually the stock market during the Weimar Republic did well if you held on to, how can I say, companies that were non-financial, that were industrial, that produced real things. They could, that had fixed real assets, tangible assets in the economy. They could do well. They could weather the storm. But I would say the stock market is really more for the very wealthy. For us, the general public, we need to think of preserving the little wealth that we have and also surviving through this crisis. There's an old saying about wars that the first victim of war is the truth. And I've seen a lot of people comparing what we're going through with the war, right? They're saying, yeah, this is the first time since World War II that they've canceled all the sports events. So yeah, I think technically we are in kind of a war. So Yeah, it's frustrating because I don't really know what's happening. So you need to really be aware of this. Right now, of course, there's so many distractions out there. It's like everyone's looking over here, and the Federal Reserve is just committing financial suicide. I think I heard someone say that yesterday. This is not my term. It is financial suicide what they're doing. They're destroying the currency. Yes, I know it's a flawed currency, but it's the currency that everyone is forced to use. So without a sound currency running through the economy, with already all the disruptions that we're having, this will be devastating, in my opinion. So yeah, this is not a time, in my opinion, to think of trading profits or anything like that. This is a time to be prepared, to yeah, keep healthy, of course. And by that, I don't even mean trying to not to get this virus. I mean healthy in general. Because if you're healthy in general, your immune system will be better off. And I'm not a doctor. I'm just giving my opinion. But it makes sense if you're healthy and you lead a life that's fairly healthy. You get less diseases, of course. But yeah, this is concerning. 5,254,278. So that's the Fed's balance sheet. I mean, to give you an example, we were around 800 billion just before the financial crisis of '08, and the highest we got was around 4.5 trillion. That was 2015 or so, or 2014. Then we dropped when they're doing the QT to around 3.7 trillion. That was end of August last year. So this has all started with Wall Street, the financial troubles, with the repo market. And the repo market, as I've said before, it's a den of vipers. Financial institutions like hedge funds, Wall Street banks, leveraging themselves to the hilt, and it's backfired on them. Together with the crisis that we're having, it's really gone off the wall. And the other thing I would say, the lower U.S. yields get, government yields get, the more it is a sign that the Fed is out there monetizing debt. So right now, the 3-month T-bill is yielding a minus 24 basis points. So it's negative. The 6-month T-bill is minus 11. So why are they doing that? Why are they driving rates to zero or even negative? Well, because the national debt is going to explode. We're almost at 24 trillion already. I think we could be at 28 or 27 by next year. The GDP is definitely going to shrink. I tweeted yesterday that it could shrink by 5%. I think it could be even more. So the debt to GDP is soon going to be at Italian levels, well, pre-crisis levels of around 130%. We're right now around 109% of GDP. The Fed's just going to keep cranking that printing press. And don't let them fool you, CNBC or anyone else, when they say that it won't matter because they did QE in the last crisis and there was no hyperinflation. But I have a feeling you can't keep doing that forever. If you could print money like that forever, Zimbabwe would be the richest country in the world. Weimar Germany would still be around. We wouldn't have had World War II and that nasty leader that came up as a result of the Weimar hyperinflation. So I'm really concerned. And I'm not trying to scare people, but I'm trying to warn you, because right now, very few people are looking at the Fed's balance sheet. And I always think it's important to follow the money because it tells you everything. So just before I look at the markets this morning, and I think it's becoming probably more and more irrelevant to look at the markets, but we will look at the markets. I want to recommend a book so you can understand what could happen. I'm not saying it's going to happen exactly as it did then, but it's some of it will. And it's When Money Dies by Adam Ferguson, The Nightmare of the Weimar Hyperinflation. So that's the book. I've talked about this book several times in my videos in the past. Yeah, now that people have time, a little bit more time, if they're at home, do a bit of reading and check this out. It's 8:11 a.m. London. So where are these markets this morning? One thing I would say, yeah, the Dow is rebounded massively. I did say yesterday in my video, we could see a rebound from the bottom over the next 2 to 3 months to around 24,000, maybe even a little higher. We almost got there yesterday, but I still think this is a dead cat bounce. I still think the stock market is going lower over the next 18 to 20 months. I think the Dow will be a lot lower. Will that mean that we won't have hyperinflation? Not necessarily. We could still have the hyperinflation after that. When people realize that the Fed's balance sheet is at 30 trillion and the Dow is at 5,000. Who knows? These are unprecedented times. And to be honest, I don't know exactly what's going to happen. But one thing I do know for certain is that the dollar, the pound, the euro, the yen, the Aussie dollar, whatever currency you have, paper currency you have in your pocket is going to buy a lot less in 2 years' time. So right now we've got spot gold 1620. It's down about 8. The bid and offer spread is still quite wide, so it's 1620 bid at 1625. Spot silver is up 7 at 1445. Pretty wide spread as well, 5 cents. The Dow future is down 270 or 1.25%. S&P is down 37, 1.33%. Nasdaq 100 future is down 1.5%. The pound rallied aggressively yesterday. We got back above 120, which was a really important level. So right now we're at 122.09, unchanged. The volatility in the currencies is a sign that all is not well. Yeah, so right now 120 will be the support for the pound. The euro also rallied. Right now it's unchanged though for the day. It's back above 110. And the dollar's down almost 1% against the yen now at 108.70. WTI crude is up just under 1% at 23.56. To finish off the bond market, we've got the 10-year yield this morning at 78 basis points. So let's see what, yeah, that's down about 2 basis points. And as I said, we got the 3-month and 6-month bill. They got negative yields. We will soon be seeing the 12-month T-bill probably going negative, the 2-year notes. So it's just a matter of time. So to conclude, keep an eye on the Fed's balance sheet. I'm going to put a link to it below in the description, a link to the website where you can see the numbers, and the link to the St. Louis Fed's website where they show a chart. Very, very alarming. So if you enjoyed my video, I'm not sure it was an enjoyable message, please hit the like button, share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, BitChute, Steemit, and DTube. I wish you all a great day. Take care. Bye.